Yeah, good evening, everybody. First of all, welcome to our live audience here this evening. Wonderful actually having you all. Again, this is our quarterly webinar that we have alongside Wealth Assist. And so very warm welcome to you. Thank you for turning out to our audience out there that's coming live. We're probably logging on. I know it takes a while just before you log on and check in. Welcome to you all as well. That's our masterclass extravaganza, and it really is, because it's an opportunity, I think, not only to educate yourself, to improve yourself, but also to make money in real estate. So we're really here to guide you to create wealth, and we've got all the wealth specialists around us here. For those of you who don't know me, my name is Neil Peterson. I'm the founder and editor-in-chief of Real Estate Investor, and we are South Africa's independent property platform since 2007. And for those of you who don't know, through our website, rei.co.za, our weekly webinars every Thursday from 12 to 1, and also our in-person events. And if you're in Johannesburg, come along to the Reside Summit and to the PropTech Summit as well. Come and join us. But for this evening, we've got a great topic. Today's topic is funding strategies to elevate your real estate investments. And I think everybody's trying to look at that right now, especially with interest rates where they are. Everybody's hoping for an interest rate drop. Let's see on Thursday whether we see any movement. I'm quite upbeat. It's going to happen soon, and hopefully sooner rather than later, because it is the big elephant in the room. We cannot remove it from a finance perspective, and it's holding everybody. Everybody's gripping on the table. Besides Donald Trump, who's holding his ear. So very interesting times that we're going through, and everybody's looking at what's happening in the world, and I think we should be looking at what we can do to boost our own economy locally. So it's wonderful having you all here. First of all, I'm going to introduce you to all our guest speakers this evening. I'm going to start off on my right-hand side. Sean Rademacher. Sean, do you want to introduce yourself?
Sure. Absolutely. As you said, Sean Rademacher, I'm the CEO of Multinet Home Loans. Very privileged to be here tonight. Thank you.
Wonderful. And Gerard, do you want to introduce yourself?
Thank you. My name is Gerard van Westhuizen. I'm heading up the investment side in our group, and I'm very privileged to be here. I'm looking forward to speaking to you guys.
I'm Daniel Lombard. Pleased meeting you, CEO of the SIS Group, and really looking forward to share exciting new insights and enjoy the time with you. Thank you.
Wonderful. So it's great having you all here. I see the numbers are climbing. I see going up. We're getting close to 100. And we don't have 100 in the room, but we're getting there. Hopefully they're all queuing outside. We'll see them a little bit later. So just so that you know, for those of you, we get this question all the time. There will be a recording. I'll promise you, there will be a recording. And that would be available directly from Wealth Assist, but it'd also be available on the rei.co.za website. And it's always good to do, to look at the replays, because there's always a piece that you miss, or there's some little piece of the puzzle that sort of disappears. So I encourage you to do that. Okay, so let's move on to our discussion, and I'm going to hand over to our very capable team over here. And first of all, Gerard is going to talk a little bit about, he's going to educate us a little bit about financial planning. And he's also specifically going to talk about cash flow, which is possibly the most important thing in real estate investing today. So I'm going to hand over to you, Gerard, if you take it forward from here. I always find your presentations, your insight is really, really insightful. So please listen up. Over to you, Gerard.
Thank you, Neil. Yeah, look, our previous webinar, we concluded with the almost reality check of the South African debt-to-income ratios. Looking at the stats, they said 46% ratio is the highest or the worst that you can go. And you will remember that it was 128% ratio for the average South African household or individual. And that's a shocker. So I was thinking, connecting that to tonight's side, looking at planning and, speaking wealth and planning for wealth, people need to understand that there's a lot of fluff in terms of, all the information and processes that you can follow. So I was thinking about this one key step of activity that you need as part of your wealth plan. And we'll touch on that quickly. And you will remember that, they gave us the stat of the debt ratio, the split as it is at this stage. 23% going to finance for vehicles, 26% of that going towards mortgage payments, and then 50% unsecured debt. That's the average split for an individual at this stage in 2024. And I thought, let me jump into one of those aspects tonight and show you how to accumulate 1 million rand in 6 years if you do the right stuff without changing much in your life. So, I want to start off by saying, if you look at the presentation, planning for financial success requires firstly a decision by yourself and the decision to commit to the process. And just to quickly refer to that, first of all, set your goals. Secondly, look at your risk profile. Thirdly, time horizon, that changes all of it. If you've got 10 years till retirement or 30 years, the game changes in what you need to achieve and the asset mix specifically that you need to take on. Investment vehicles, that is so important. That refers mostly in my mind to tax. The tax structure that you use, capital gains, income tax structure, estate duty, all of those things are critical when you look at the investment vehicles. Then
you must help them. This is not investment vehicles.
Yeah, it's actually not vehicles because I will focus on vehicles. Structures is maybe a better word. Structures is better.
I'm just joking.
So, but then you need to go into a process of continually revising that plan that you've got. And then lastly, in my mind, most importantly, the one reason why I believe people will lose less if they've got professional advisors around the table all the time. But the one key in that activity that you need to get to wealth in your portfolio is cash flow management. It doesn't matter if it's a business or it's your personal finances, cash flow management. And I'll show you tonight. It's just crazy. Now, this weekend, you might have read the report in the newspapers that came from FNB 2024. That's their research on their clients. Now, look at what they're saying. 7% of their clients' budget is going towards retirement. But the biggest shock is the same percentage is going to clothing every month. And I think, what's this? The profile of this client is their middle class to higher income. Middle class, in their definition, starts from 180,000 Rand per annum, which is 15,000 Rand per month. Now, if you look at the previous webinar, you will realize that to get into the 12%, you earn 25,000 Rand in South Africa. So this is typically the middle class. And they're spending all across the same amount on clothing per month as on retirement. Now, the second figure that they gave us was this: 2 months of salary is saved for as an emergency fund for 34% of those clients. 9% saves up has got 3 months of saving in an account, 3 months salary, in other words, and 5% has 6 months and more. Now, the last figure, 50% of South Africans have zero emergency fund somewhere. So it's like on the bone, as the one guy said to me one day. It's cutting on the bone. You'll feel it. And that means that the principle is they are not managing their cash flow enough and they don't know what will happen if something goes wrong. And more seriously for me is they're not saving. That's the only reason why there's no cash in an account. They actually don't have extra cash flows. So my favorite topic, as you know, is inflation. So when you start with step one to say, listen, I want to set some goals. One of those things is, what do I need to achieve? And I always say in South Africa, remember, you need to outperform inflation. And the reason being, you need to protect your buying power. And if you don't, and if you look at this figure, 25,000 in 2016, you need to be earning 36,000. If you don't, that bread will be half. In other words, you will only be able to buy half in 8 years' time because of inflation. So inflation is your biggest enemy in South Africa, and that's your first benchmark when you look at investment growth. And thereafter, you start to look at my actual growth on my portfolio. So therefore, I always say in South Africa, you need about 12.5% per month, per annum, to actually let your capital grow and actually maybe more. So if you look at property and guys are earning 10% on a net side, or 9% or 8%, it actually doesn't make sense on the long term because you will buy half the bread every 10 years in South Africa. So that's just one aspect that I wanted to say. And I always say, let your money start working for you because your salary might not. But then I came across this one concept, and it's called lifestyle inflation. And if you look at the definition, it basically said spending more as income increases. So I'm earning more. I earned at 25,000 in 2016. Now I'm earning 36,000. And what do? I actually spent more. And that is detrimental to your wealth creation. So this is typically examples that you will see. Expensive cars. We'll focus on that now. Frequent, frequent dining out. No, not me. Last food. Designer clothing, luxurious vacations, expensive hobbies, cycles, 100,000 cycles. I need to finance it because it's too expensive. So the reality is that creates an additional load, and it's called lifestyle inflation. And that is a very bad thing in terms of your long term. And I'll show you financials now, what I did. And I didn't realize it because, when I was taught this in the 90s, I thought they were lying. And now I spoke to an actuary friend of mine. He said to me, if you finance a car in South Africa, you better drive it for 10 years. I said, why are you saying that? Well, there's big reasons for that, big financial reasons. So I had a Honda Cash. Man, it's a pop-up light one. It was very nice. Really, it didn't burn me every month. It was cash. And then I made this decision in 2008 to actually buy a Isuzu, 65,000 rand, double cab, canopy for my family. I had twins. They had to have space. And you know how you back for a twin on a holiday. It's just crazy. So I went out 4-year term, 11.5% at that stage was the fine rate. And it's only costing me 1,679 rand a month. Oh, brilliant. So not a problem. But then you look at the numbers 4 years later. So my Honda dropped to a value of 16,000. So I lost 4,000. But my Isuzu dropped to 53,000. And you will see that my total payments to the bank was 80,000. So the difference there, I lost 27,600. That's 7 times the loss of my Honda. But that's actually not the key and the real loss. So if I chose to invest the 1,679 for 4 years at 9% per annum, which is an average growth, I would have had a total investment value of 96,000. The value of my Honda would have been 16. My net asset value on those two would have been 112,000 versus my wonderful double cab. I lost 27,000, but my net loss over 4 years only as a young man was 84,000 rand. Now that doesn't make sense, does it? So I want to tell you, if you understand the numbers and you start managing your personal financial cash flow, you would have said, but listen, now I can buy the 53,000 Isuzu cash and still have 50,000 rand in my bank. Now, that is, many years back. And then the banks came out and they said, let me do you a favor. Not 4 years, 6 years. We'll make it easy for you. Go and buy it for 72 months. And it's very affordable now. But let's do an average calculation. You can measure yourself in terms of your current car and what the new prices are for cars. Buy a simple one for 360,000 today. It is 11.5% again. And let's see, 2019 model. That's an actual vehicle that you can buy. The cost is 6,878 plus the insurance, which I got at a very good rate, 8,000 a month. Right after 6 years, my value of my paid, what's that? That was a RAF, ne? Was 265,000 from 360. So what I'm saying to you guys is keep the car that you've got now that is paid cash, and rather decide to give that money to a bank or an investor that can invest it for you for the same amount of time. And then you'll see, after 6 years, you'll have 767,000 Rand in your bank account, paying out of your investment. Your car, if you just kept it, the one you've got, let's just work on the same model, is 265,000 because it's paid off. So the minute you reach that point where that car is paid off, and you start investing just for 6 years, drive that old car for 6 years and invest the money, you will make your first million in cash in 6 years. Because now what you will do is you will go to the dealer, you will, who's this? I want the bigger guys now that's buying all the cars. Take my old car, please take it from me. I'll finance the new one and I will use my million Rand to start investing. Just 6 years, you will change a family's life. That is the key. So, or you can come to us as well, Wealth Assist, give us the million, and then what we will do is we will pay you 12,000. Hey, that's a big amount. I would rather say, let's say 12,000, not 12. It's 121,000 if I take out the space.
That's a good figure, that one. I hope
bring
that to the people now.
So the real amount was is 12,000 Rand a month. So we currently we net 14.75
net yield.
Net yield. So that's 12,000 Rand. We'll give you 40,000 Rand per annum on the capital growth side. And what you can then do is use that investment return and pay your car and still have 4,000 Rand left. So create wealth-producing assets first and fund depreciating assets with them. And that's the key. And that will sort of minimize the whole discussion about it. So if you are in short-term debt vehicles, unsecured debt, it is an absolute killer. You need to sort it out immediately. Get out of it and avoid the long-term effect of that in terms of your wealth creation. So meaning, if you only have your salary to start investing, use your finance capacity to buy income-producing assets. Don't use it for anything else. So,
which is obviously why Sean is here as well.
So
explain that.
But that's the thing. If you want to use debt to build anything, or use debt, use it with Sean. So just the next steps from, if you want to, as the crowd online, if you want to just scan that thing, you can immediately make contact with us, and we'll put it up at the end again. So thank you.
Great. So if there's any questions, Q&A box at the bottom on your right hand side of the screen. Please post your questions. We'll deal with it at the end because there probably are questions. I can guarantee you. And you're unsure, also basically no such thing as a silly question. Okay, so Sean, I think let's talk a little bit about, you're going to talk about financing properties, property journey, also how to apply for finance for investment properties.
Yeah, absolutely.
Do you want to take us?
Yeah, so first thing I think we need to understand how you can get property finance in South Africa. There's two ways. You can either go directly to your financial bank that you bank with and you can apply for a loan, or you can use what we call in South Africa an originator. And what origination companies do is they take a single application. They have an IT system that is linked in with all the major banks in South Africa, and they submit one deal to all the banks and they get the answers back from the banks. Now, the reason why it is better to get finance through an originator versus going directly to your bank is because the banks compete for your business when it comes to an origination company. I remember in the past, the insurance, when the direct insurers launched, it was always about come direct because it's cheaper than using a middleman. And a lot of people get confused with an origination company in insurance. They think if you use an originator, it costs you money. In actual fact, it doesn't. We've done the stats over the last 20 years, and on average, we save a customer just under 1% on his interest rate. Now, for you, that works out a 20-year loan, that's a percent on R1 million. It's a lot of money. So that's what origination companies do. I think what's important to understand is, who the originators are in the market. So we are one of three. You would know us as Multinet Home Loans, and you would find a lot of us get referred to from estate agents.
So, Sean, a few questions here. So we know that there's trends in banks. Some banks are granting loans, like, for example, Standard Bank has opened the taps. Absa is Bank of the Month, and it varies from month to month. Can you maybe share at the moment, because look, at the moment we're in a very tight sort of interest rate environment. Banks are pretty tight right across. Are there more banks that are more open for business than others that are not? Because normally there is that kind of trend.
Yeah, so maybe let's take a look at the trend over the last 4 years. Just before COVID, we were sitting at an interest rate of around about 9.5%. COVID, we realized that it was the lowest interest rate in the history of home loans. We dropped all the way down to 7%, and we're now sitting again at, I think, 11.75%. The banks have got a mechanism that they look at affordability. So when interest rates go up or down, your affordability adjusts as well. So all of a sudden, when the interest rates were sitting at 7%, the affordability on consumers that earn 10,000 Rand was much higher than what it is now. So the banks always look at affordability in terms of those scorecards. So that really doesn't change. What does change with the banks is when they start seeing risk in the market. So some banks might see risk in terms of an industry or a specific income bracket, and they will steer away from that or offer higher interest rates. And other banks will say they would willing to take that risk because they're growing their book. Also, and unfortunately it happens that way, sometimes your own bank knows more about you than what other bank does. So, your own bank's going to say, but we know how you pay. We're not interested. And a bank that hasn't got your transactional account says, well, everything looks fine, so we'll take you. At the moment, all the banks are competing heavily in the property market. In actual fact, they're all looking for those quality customers to come through. And we've seen some exceptionally good rates, prime minus 1.5, prime minus 1.7.
Sure.
So it's great for the consumer. The consumer gets the benefit of getting the low interest rates.
Yeah. So we hope when interest rates come down, we hope to see a lot more activity and affordability.
Absolutely,
As well.
absolutely. We actually, we're seeing a predicted 2 interest rate cuts for this year still. On the back of the US inflation rates that are down. I think that's great. The moment the US starts dropping rates, we have the window to do it as well. Our inflation rate is also slowing down, which is a great sign for us. I don't think the next one will be a cut. I think we'll stay the same, but hopefully 2 before the end of the year.
Yes, I definitely concur. Do you want to?
Can I just ask Sean, lots of clients, especially investors, sits with a situation where they've got multiple properties, maybe already 2 or 3 or whatever it is, and don't necessarily owe on them. Okay, some of them are paid off, that type of thing. Just maybe share a bit about using that finance, the fact that you got good rentals on those properties, place you in a position to conservatively, and I must say that, not going to maximize all your property equity in the whole picture, but rather just use further advance. How is the banks currently looking at that type of thing? And the second question after that is, if you can explain a bit more about why is it more difficult to use structure kind of companies, that type of thing, trusts and all those fantastic things they teach you in theory, but how does the bank see that?
Absolutely.
I think that's very important.
Yeah, so I mean, if you're a property investor and you've got 3 properties that are paid off and you're getting a rental income, I think you've got a bit of a tax issue.
Exactly.
You need to gear yourself to a point where you have expenses like interest that you can write off on your income so that you can get higher return of your investment. So it's always good to gear yourself healthily. You don't want to go to 100% gear ratio, because then you're also not making the money unless you're investing in more property.
Exactly.
So then if your property investment on the 100% of your current property portfolio gets you again to a 50% loan to value, that's fantastic.
Yes.
The banks are very, very willing to do further advances. In actual fact, every bond that's registered now with most of the bank, they've got what they call a future use facility. So you've already paid for that. It's normally 10% of the value. Some banks will go up to 20%. So you don't have to go again through an attorney process. You don't have to go register a bond. So you can go to the banks and ask them to access that 20%, and they will be able to give that to you with no additional cost, which is fantastic.
So if I can make it practical, if you sit with this R1 million property and you want to access, and let's say call it 600,000, you might as well maybe even ask for 800,000 but only utilize less,
Yeah.
or whatever, or do they automatically add the?
Yeah, so what the moment you go over the future use, you have to do an application again.
Okay.
So you do that. What we're seeing in South Africa, and Daniel, you've spoken about this often, is that consumers don't see the benefit of the value that they have in their property. So when a consumer bought a property for, let's say, R1 million 10 years ago, and they've been paying their 10,000 Rand for 10 years, the property value has grown by 5% a year.
Exactly.
So let's call it that you're sitting in 1.5 million value. And you've also paid off a little bit. In 10 years, you've actually mostly paid interest, not really the capital.
Yeah.
But there's a capital appreciation. But you're also sitting with 300,000 Rand worth of personal debt. And your personal debt is costing you 27,000 Rand a month, where if you extend your bond with another 500,000 to reduce your personal debt, you're now getting to a point where you're only paying 4,000 Rand for that extension.
Right.
So you cash flow wise, you're saving 22,000 Rand, which you put back into your bond, which eventually makes sure that you save on that interest.
And drop it, the outstanding amount again, so that you can actually utilize it for investment purposes instead of.
And it's so important. And I mean, we said 53% of debt today is personal loans, unsecured.
Yeah.
And unsecured debt sits at 22 to 27%. I mean, it's crazy.
Yes.
You know, with a home finance, you can get your debt, your interest at around about 11.5, even 12%. It's half. And I mean, if we talk concept of compound interest,
Exactly.
it just makes no sense to continue with your personal loans.
I like that. And then the structured one.
Yeah, so the banks are scared of the structured facilities, and the reason why is a trust isn't as easy to close or foreclose as an individual. So if you're buying a property in a trust or in a company, it needs to have had 3 years of trading. You need your directors and shareholders and beneficiaries need to be able to sign surety. So in essence, you in any case signing surety as an individual.
Yeah.
But if you're not willing to do that, the banks will hardly look at putting it into unless you've got a track record and a big cash balance.
And you've built quite a large portfolio that maybe give you that cash flow.
Yeah.
And I think just, one of our investors here present as well can tell you, you always have another challenge. And that's when you start working and bring that back to that point which you spoke about, where people want to use their own bank. Then the guys always talk about this lovely structure that they're going to do for you. They're going to give you a facility, beautiful, okay? But then they charge you a structuring fee. What was the other fee they spoke about?
Yeah, it's a raising fee.
It's a structuring fee. And on the end of the day, as an investor, it costs you actually substantially more. And then you've still got your bond registration fees. So it just becomes such a large cost to it that it starts not making sense anymore. So you must be careful of just the theory about the whole structure. Just look at it very carefully. If you haven't got a long-term plan to make it your business, as you call it, always, then rather leave it.
It's also difficult to get properties out of your structured facilities.
Exactly.
Because what the banks will do is they want to keep the gold nugget in your structure.
Exactly.
So if you've got 4 or 5 properties and you need to let go of one because something's happened, you're going to find it difficult in a structure. When you have it as individuals, it's easier to get rid and buy additional properties.
And I think also when it comes to, I know 13.6 and other tax beneficial transactions, you must also be careful, because when you start in a structure, then you can't take it out of that structure, as you mentioned, and even on the personal side. Then you can't later try to move to a company because it just costs you too much to move all those things. So I think what I want to say through that is, in the beginning, and I think that's something that you would probably confirm, is rather make sure of your strategy and your plan. Like Gerard said, have a plan, have a goal, have all these things, and at the same time say, what kind of finance am I going to use for the future? Because you may be in that for a long term and not be able to get out of it. Okay, so
yeah, absolutely. And like you said, the planning is so important. If you're going to start a property portfolio, you need to have your tax affairs in order.
Exactly.
If you're in a trust, what is the capital gains on a trust? If it's in a business, it's the same thing. The VAT claim back, the VAT payout. So if you're going to do this, make sure that you plan.
Mm-hmm. Good.
Now, Daniel, you're going to talk about collaboration. And and then we'll get into Q&A. Once again, I say to the audience, please, if you've got questions, and thanks to our live audience as well, if there's a question, please pose it to us. We'll deal with it at the end. I know there has been quite a few questions that have come through. Some of them we've actually dealt with them in our discussion already, but we'll revisit them a little bit later. So over to you, Daniel.
Thank you. Yes, so I'm going to talk about collaboration and actually what does it really mean in the wealth assist environment. I think, some of our Afrikaans guys, or maybe some of the other languages, I sat in a meeting one day where the guy speaks about the bite. And I just thought to myself, okay, what do I understand as a bite? And I asked the other audience, which is 90% Afrikaans, what does a bite mean? It was really funny what came out. So I think sometimes when we think about what's the word collaboration mean, and I think this summary of it is actually, this is the dictionary summary, sums it up very well. It says, collaboration is the process of working together with others to achieve a common goal or objective, and it involves sharing knowledge, skills, and resources to accomplish something that couldn't be done alone. And I think it's in our environment and what we were talking about in real estate investment and that type of thing, it is very important to collaborate. Build relationships with all these power partners and people like Multinet and these type of things that can advise you, and we all think we know a bit, and some of us think we know a lot. And we can always learn substantially more in the way, if we just ask a bit more questions, deal a bit more with some of these things. And I think I tried to sum up here just a bit of an idea about the key to collaborate. Okay, so if we run through, we've got in Wealth Assist, if we talk about what is the process of working together with others, it includes things like the valuers, inspection, the bond originators like Multinet. We've got wealth, the guys who deals with the real estate owners on our side, recovering real estate owners, project managers on maintenance on a national basis. So it's sometimes difficult when people invest in property and you get a fantastic deal, but you got the wrong maintenance guy. I don't know whether you experienced that one, but that's quite a challenge. So those type of things we need to get past. Then obviously a lot of our ambassadors, people that we deal with specifically getting these opportunities. Who of you have struggled to find great real estate investment opportunities? And the time that goes into that is quite a lot. I think on the end of the day, in our situation, because we collaborate with a lot of these parties for a large client base, if I can call it our Wealth Assist investors, we don't do it for this one transaction, and now it's costing you a fortune for this one deal to do, because we do it every day for, call it 1,000 investors or 2,000 investors, and prepare these things for them makes the collaboration so much easier. As well as the service providers, we can negotiate better, that type of thing. And then information. I mean, you all probably know and use TPN, the NCR, you use the CMA, Lightstone, Private Property, Property 24, whoever they are. And in that whole collaboration process, I think it's very important to see, do I have to pay for all these things, or maybe I can just use someone that does it all for me? And that is part of, I think, what we're trying to achieve on your behalf, not even talking about the skills and all those type of things, which we'll get to. And then the same, when we talk about attorneys, when you start looking at your contracts, are your contracts properly done? How does it work? I know some of us here is experienced investors, but even when you're experienced, and I've been in property for more than 40 years in the investment part, and I can still make a mistake if I miss something on an agreement. So we, as a standard thing, give it to our attorneys to draw up, make sure that but the fortunate thing is it's all inclusive in our transactions. And that's what makes it so much different from working with on your own. So if you go to an attorney and every time you have to ask him to go and verify your contract, it starts giving you a lot of money. They become a lot of money. In our transactions, the transfer fees are included, okay, which is something you won't get somewhere else. Okay, it's those kind of contract fees are included. Your deposit holding attorneys structures and things are already in place, and it's all there. And that whole collaboration is what we call our collaboration with other people. And then I think the common goal and objective, what makes Wealth Assist products unique, is that they enable all participating role players to achieve their goals. Okay, although Mr. Investor's goal is something, and Mr. Real Estate Agent's goal is another thing, and for the attorney is something else. Okay, all of them have got goals in this process. But what we do is through one common goal of the type of transaction that we do, we actually help each of these parties, the real estate owner, the real estate investor, all to achieve those kind of goals. So I think just to touch on a few of them, Real Estate Assist, we obviously, I don't know if you know that, but our profits and what we share in the profits on the end of the day of each transaction, but we only do it after our real estate investor have actually earned his return. So we make the decisions on our credit risk committees on the basis that we're actually looking at the transaction if it's our own, okay? Because we share in those profits, but they only get them if you get yours. All right. So I think that's important. The other role players, estate agents, I've touched on that part, real estate owners' goals. So in our transactions, there's always a real estate owner which we try to make impact with, okay? Change the current situation, take them from a position of distress into a situation where he can actually keep his home, or if he can't, assist him to maximize what we get out of those transactions on the end of the day. Then we have the investors' goals, which are you guys here, that we look at. Invest with minimum time effort. That's basically what we're trying to achieve here. Invest with minimal time and effort, best returns with low risk, financial and social impact at the same time with all our products. And that is, if it doesn't work within that sphere, we will not do the transaction. It needs to be a win-win for everybody in the whole picture. Then sharing knowledge, skills, and resources. I think everybody that plays a role in this process, which we touched on already, by working together, the benefit comes to everyone in the package, and it brings us to what we call our massive transformative purpose, is actually to place a product in the hands already pre-vetted, risk mitigated, security looked into, do the due diligence, the whole package of that, but at the same time use property to help all the parties in the whole, call it recreating your world through real estate. Then accomplish what couldn't be done alone. I think that's very important. All of you are real estate investors and all busy getting onto that ladder, or whatever the case may be. So in that case, you know what the difficulties are. I asked a guy today, how much time do you actually spend in finding an opportunity? And he says, well, depends, but that's my job. And I actually do it most of my time now because I haven't got a job currently. So the effort that goes into that, whilst I said, well, would you like some easier access to opportunities? And he says, yes, that would be great. I said, go to our website and you can actually do a proper due diligence. Everything is there. Real estate valuations, your full-on inspections, all your figures already calculated for you, and you can view it if you really spend a lot of time, maybe 2 hours, and everything would be done for you. If you can find opportunities in an easier way than 2 hours, I think it's an easy job. Okay, so and then obviously through this, the need and the opportunities outside, and most of them have, all of the people have actually touched on that, is the debt ratio in the country. It's a huge issue at the moment, short-term debt, and we've touched on the percentages and so forth. But on the end of the day, if you look at the currently, I think it's about 68.5 billion rands with the residential mortgages that is 90 days or more in arrears. Okay, there's a vast opportunity to solve this problem, and for you as an investor, you are now in that position where you can do a property investment, have a far better tenant than just a normal tenant, because this guy is a kind of tenant that wants to buy his property back. He looks after it. He pays the maintenance himself. He pays if the interest rate rise, it covers your interest, and those type of things. Just go onto our website and you'll see a few of those advantages, which is not in the normal type of transactions. So collaboration, guys. I think we try to do that in such a way that it be beneficial for everyone in our circle. And on the end of the day, for you as an investor, provide you with an opportunity that you've got a lot of professionals giving you good advice, like we had tonight with insurance case from Multinet. So we specifically, all our investors, we look at doing a pre-qualification normally upfront, because it enables you to see, what have I actually got? What can I achieve with this credit that I have if I use it wisely? So thank you very much.
No, thank you. We've got a lot of questions, and so please, if you've got questions, please keep sending them through. We're going to deal with them now. Some we had touched on, and some that I'd like to go in a little bit more depth. I'd like to ask our audience here, is there anybody here that has a question? And don't all shout together now, please. There we go.
We've got it.
All right, so this microphone over here, if the gentleman can just hold that one over there, so that everybody can hear the question. Yeah.
Thanks, Neil. So I just want to quickly find out, so in the process of acquiring a Wealth Assist product, would the banks also take into consideration the predetermined rental income then from this property when you do the application?
Yes, they will. Yeah, so they will take that into account, because the Wealth Assist product is buying a property. So it is a property that's in the market. You are buying it. You aren't transferring it into your name. And the existing rental, if we can prove that the customer will be able to afford, we can even use more of that rental as an addition for your affordability.
I think you've
Any more questions here? Yeah, we got one across there.
I think important just on that is that we found that through experience over the last 10 years, is that exactly what you said, the bank takes our leases. It's a normal lease. The only difference with this lease is it is for 2 years or 3 years, not just 1 year. So it even adds a bit more value here.
So my question is for Sean. So you mentioned earlier on that the banks actually compete for your business. In my view and in my experience, the banks are taking a very much more conservative approach, and there's not much competing going on. When they look at you as an individual. They don't really, and excuse me for saying this, they don't really care about what FNB is thinking or what Absa is thinking or what Investec is thinking. So maybe you can explain how the competing actually happens, because in my experience, I haven't seen that.
So I'll give you a typical example. You're a Absa customer, and Absa has come back with a home loan with prime -1. And you say, well, let's see what the other banks are going to offer. And Nedbank comes back and they say, well, you're a first-time home buyer. Not only are we going to give you 107% loan to value, but we're also going to give you prime -1.5. So now your main bank is giving you prime -1 and the competitor is giving you prime -1.5. Now your main bank says, hold on, you're a great customer. We don't want to lose your transactional account. We'll give you prime -2 just so that you can stay. And that's how the competition works between the banks. So even as an individual, you might see that the banks, if you're not a If you're an individual that's struggling to get finance, you might see the banks won't really compete for that business. But if you're an individual that's got quality credit, you pay your home loans, they can see what you're doing, they'll fight for you.
I think the experience you have, I just want to answer that because I know it personally. I was involved in it. He set up a structure,
Okay.
which we was advised to do, and what happened was, and I want to make it clear, I didn't advise him on the structure, but whoever advised him on the structure, on the end of the day, didn't give him all the facts, and that what you need to do. I mean, like a simple thing. If you want to use a structure, you need to pay your monthly rental into that account. You need to do, they need to see a history. And that's what Sean's talking about. So in your case specifically, I remember that your bank at least dropped the rate somehow, okay? And also through negotiations where they charged all these additional fees, they dropped some of those fees because Absa's rate was better than his bank. Okay, so in that case, he said, okay, I'll go with you guys, but you have to kind of drop your rates, which they did. So not much, but they did.
When it comes to structured lending, there's not too much competition there because it goes to a specific team in the banks. So when it's a normal home loan, you go through the normal channels. Structured lending goes to normally your wealth assist or your wealth divisions of the banks. They look at it totally differently. And when it gets to structured lending, they don't really compete then because they believe that they're giving you the best deal and no other bank is going to take this into account and give you the same structure. That's why you would struggle with structured lending to play the banks off on each other because they're taking not just your properties into account, they're taking your businesses, your cash flows, your personal shares in other companies. And the banks don't, the other banks aren't looking at that. So when you do structured lending, there's a few banks that will do it. Still come through us because I promise you we'll be able to push the banks to get the best deal.
Hardy actually helped them quite a lot in the process.
That's fantastic.
But it was a struggle.
Yeah, it was a struggle.
I do understand where you come from.
Yeah, it was way too painful. It was way too painful.
That's where we take the pain out of it.
Yeah, but maybe, with that, maybe there needs to be a little bit more discussion, obviously not here, but in terms of, how do you do things differently? Because now you're going to get more structured lending, because it makes more financial sense based on one's personal, tax bracket and all that. So you will take all those things into consideration. So I think we would maybe benefit from some of that additional negotiation. Yeah.
Yeah, we do have very skilled people that work very closely with our net worth individuals. And we refer them to those individuals to do the structured lending. So they speak to the Investex, the RMBs, the FNBs if they do the structured lending, the one accounts that used to be there. So we do those.
Yeah. And just one other comment, sorry. You mentioned earlier on that when the value of your property goes up, you can actually borrow against that. But what banks actually do as well is they reevaluate.
Yes.
And they give you a new interest rate as well. So sometimes it's better and sometimes it's not better.
Yeah.
Depending on where you are. So just for everybody.
Yeah, that's true.
All right.
Good. If there are any more questions from the audience over here, you're quite happy. Okay. Good. We've got quite a few to get through here. From Madeline. And Madeline asks, and you actually spoke about it earlier on, Sean, what is the tax implications on your rental income? But before you answer that, there's quite a very simplified question in the sense of how do I buy my property in my own name or other entity? Well, I think just before I just put it out here to the team, I think the most important, I would say to anybody first, before you getting any advice, is just to educate yourself first through a number of sources yourself. Educate yourself, get yourself up to speed on some of the basics. And then I think that is when you put out questions like this, because it's very important to run, I think, your own numbers. So let's talk a little bit about, because for me, there's two aspects to this question. What is the tax implication? Is it in a company? Is it in a trust? Is it in your own name? So depending, of course, what your objectives are as an investor, do you want to go for 20 properties? Do you want to go for one? Do you want to go, are you buying a house? So these are all the sort of things you've got to look at. because then you have to look at your tax aspect in terms of that scenario. So that's just so maybe just give us a simplified version, and then it all depends. It's very much a personal decision whether to decide to buy in your own name, in a trust, in a company, and based on your personal objectives.
Yeah, so I think, there's the two taxes you need to have a look at is your personal tax. So it is the income tax that you're going to have to pay, your PAYE tax rate, and of course your capital gains when you sell your property.
Sure.
So if it's in your own name, it's not your primary residence, you sell it, you're going to pay the capital gains on that. And if you are making a profit on your rental, you have to pay your PAYE tax rate on that rental. I'm not the tax expert, so if I'm wrong, in terms of company, you need to consider company tax. So are you going to register for VAT? If you register for VAT, you can claim back your transfer fees and a lot of the fees that you pay for your attorney, the VAT on that. But when you sell your property, you have to sell it also VAT inclusive and pay the VAT over. So it becomes quite complex. And then, of course, your company, you have to do your provisional tax, you have to do your company tax, and then, of course, you have to do, if you take money out, your dividends tax. Are you running expenses through the company? Is it a property owning company? So tax becomes quite tricky when it's in a company. When it's in your own name, it's actually quite simple.
If you sell.
If you sell as well. Yeah.
That's the big question.
Yeah.
If you sell, guys, if you sell.
If you don't
a lot
sell,
of people keep their properties on forever. They do. I'm not saying that's the way to do it, to advocate. But if you sell, you pay the price.
Yeah, that's true.
I would just sum it up in a very simple way. There's no one way. All right. Everybody's situation is unique, and if you don't have a auditor who understand property taxes and all these type of things, we have got them in our collaboration package. Okay, so they will definitely guide you in those type of things, and then you can go back to your own auditors and verify those things. Okay, and just make sure. But it's important to get the right advice, guys, in the beginning, not later. And I'll just use a very practical example. If you're going to buy 20 properties a year, and you're going to do our type of transactions, I can tell you exactly on our institutional side what the tax issues are and the benefits are. You can buy properties and you can actually register that company for that, because the stock that you buy, you're automatically going to sell, for instance. Then you can do that. You can actually register for that because it's seen as stock. But that's not for every person who, for instance, if you do that same structure unadvised correctly and you rent out those properties, you are not actually allowed to claim that VAT back. Okay? And things like that. So if it's on sales and it's stock, buy and sell, different story. But when you have a structure for buy to let, building something up for the future, even do our transactions where you rent it out, not with a purpose to sell it, you won't get that tax, that VAT back and that type of thing, and you can't use that. So I think it's just to simplify it is get the right advice. And if you don't have the people work with us, we've got structure, people who work only with our structures, attorneys as well as auditors.
Okay. There's a nice question, I think, coming up for you, Yahira. Excuse me. Seleka said, when you take further advance on your property for personal expenses, how do you deal with the interest expense as a tax deduction on the money you didn't improve to improve the property?
That's a good one.
Well, seeing that I'm not a tax advisor, but I can. No, but the thing is, how do you deduct those interests? You can't. It is a personal expense. You have it's not a business expense. There's no reason that SARS will say, well, gladly, I'll give you the deduction. There's no chance. So the problem is, the biggest problem that they did there is they paid off, like that gentleman that we spoke about today, paid off that debt. Now, suddenly it was supposed to be 5 years or 4 years. Now it's 20 years. It just doesn't make sense.
Just to add to that, I think important, is if she used for further advance, the bank doesn't know what she used it for. The taxman doesn't know. She will get the benefit on the fact that she's paid interest, higher interest on that money that she borrowed. That's going to be a fact. Okay,
Yeah,
she is going to, her net rental income is going to be less. So she's going to pay less tax on that. That's a fact. If you use the right articles to deduct that before you pay your taxes. So you will have a benefit from that. But
So I caught the question being, I've got my own property and I increased my bond facility. Is she referring to an investment property?
Well, there's no specification on what
So
property it is.
if she's referring to an investment property, yes, the interest will be high and she will have a bigger deduction in terms of interest paid, which is definitely an option because the banks won't know, but they will only see the interest on the mortgage.
But the challenge with that is, why do you buy over 20 years that deflates in value?
To zero. To zero.
Please don't do it.
Okay, another one from Tebogo. Hi, I have a residential property that is paid up. I'm busy trying to venture into investment property. My first challenge is the judgment that I've discovered year before last. I will be done with my last payment on the 30th of September. Can I use this property as leverage when I start the property investment portfolio?
I think the starting point there for Tebogo now is get in touch with us, not only as an investor, Tebogo, as a real estate owner. Come to us, we sort out that judgment, we make sure that on the end of the day, we clear your name, get your credit score to what it should be, and it won't take a long time for that. We can advance we've got products that actually will settle that debt if that debt is still in your name, and clear that debt on the end of the day, and then change it to a normal mortgage where we can borrow a bit extra if the percentages are correct and as Sean spoke about, not over extend yourself and that type of thing. And you can use that money then at a lower interest rate to borrow money at an expensive interest rate, call it 17% or whatever it may be out there on short-term loans and these type of things to make an investment is not wise.
Okay, we got a question now from Anonymous. And he says, hi, I have 5 properties, 4 investment and 1 primary residence. They're all on finance. I've registered a trust and in the process of registering another trust. Should I transfer these into trusts? Banks do not show appetite of transferring. Okay, I don't know who wants to have a go with that one. I mean, so it looks like all those properties are all in his own name by the sounds of things.
I think before you do anything, I will gladly arrange a meeting for you with proper structuring guys who can give you the right advice. And I think after that, you'll know exactly what to do. But just don't jump into this thing of trusts. I know they got all these wonderful schemes where you at the end have 10 trusts. And just think about all the money that it's going to take to do the books, to do all those type of things. Sometimes people, just to use a practical example of an investor, we've got one investor that owns more than 35 properties. It's all on his personal money. All right? And everybody advised him against it from the start. Okay. Today, he's got, I think on 90% of them, he's actually got 13.6 advantages, everything is in his personal name. But he's the type of client that it worked for to do that. But in your case, it may be different. So let's sit around the table, look at your structure, look at your total plan of future investment, because that all needs to form part of the decision-making when you actually go into the trust.
Well, I believe a trust is there to protect assets for the long term, for the next generation.
And estate planning.
I'm not the greatest believer of using a trust as a business vehicle. And I think his biggest problem most likely will be to get the refinancing in place, because all of them are financed into the trust. It's going to be a massive exercise, not even to speak about the costs.
Yeah. And there's going to be third trustees, things like that. You can't have 2 trustees. You have to have an independent. Things like that, which is very important.
Yeah. Interesting story. You probably saw recently now, SARS actually won the case against Christo Visa.
Yeah, so
And he's highly structured, and he's in different companies, trusts, you name it. And in this particular instance, he lost the case. I think it was more than 200
lifting
million
the
rand.
corporate veil is
And so, look, sometimes you win, sometimes you lose. It's obviously, for and again, not to say that that's not the way of doing things, but obviously SARS is very hungry at the moment, and they're obviously lifting the lid on absolutely everything at the moment. So you've got to make sure you've got to keep everything squeaky clean all along the way.
But-
They got big appetite for people that are not compliant at the moment.
No, for sure. I think one of the steps was to actually determine your own risk profile, which also includes your risk appetite.
yes.
And, the risk appetite includes the stuff like, I need to have an accountant who do my bookkeeping. I need to present financial statements. The cost involved in that process. There's so much, SARS doesn't smile when you're not paying them. That whole argument, and when they come back. And I found that most of the normal property investors that I've spoken to actually wants to be JSE investors in property.
Yeah.
They want to have clean-cut decisions, easy returns, not manage on a daily basis. That's not their profile. And I think you need to make a decision where you want to be.
Okay, great. I like the story of the 35 properties in a personal name. I think it takes exceptional discipline to do that, but it is possible. And I think if you manage your finances correctly, it's possible to build that kind of portfolio, and you are disciplined. I think that's what it
He is
comes down
very
to.
disciplined.
Yeah.
Well, there you go. So discipline's the answer, people. All right. So Nuka Holdings. I have a property where I live while renting out parts of the property to assist with the bond repayment. I have some cash which I can use to build another flatlet on the property. Would you advise that I use the cash to invest in another property, or should I use it to build the flatlet?
Easy one then.
Well, it all depends on how much cash he has.
Yeah. Cash, yeah, that's the Nuka Holdings.
Yeah, I mean, normally when you build a little flat or another room on your house, you're talking about 100, maybe 200,000 rand.
Yeah.
You're not going to use that money as a property investor to go into a new property.
No.
So probably if he has 200,000 rand, build the flat, rent it out for 4, and build up that capital again until he can invest in
We've got
something bigger.
a portfolio like a spreadsheet type of thing, which if I put the numbers for you, if you give me the quotes for the property, what it's going to be costing you to build it, because remember the old simple rule, count the cost before you do anything. Okay, so do that, counting the cost, get the actual quotations, see what it is. I've got investors that did exactly that same thing, but when we did the sums, the yield, the net yield, was 7%. Okay, so then you must ask yourself, can I buy something better in the market for 7% net than 7% net yield, or what can I compare it to? And I think that will help you to make that decision more soundly. So if you give us those figures, it will literally take me 15 minutes to tell you what the yield is on that, taking all things in consideration. Because when you work out the yield, don't just say, okay, it's my rental collection. You have to budget for maintenance, you have to budget for insurance, you have to look at all those things, look at the comparison, and that with your current property can actually be far less because it's already covered and things like that. So it needs to be, you need to look at it properly to make a sound decision.
So from the Wealth Assist side, we actually assist our clients to make decisions like
those
that.
decisions. Without additional cost. Yeah.
Ironically, the land comes in at zero, which is the most expensive portion of any development. So he's got an advantage. The biggest issue for me is personally, if I wanted to build in that flat, is how many builders will I kill before then?
Yes.
Because I know I fired the last one, the third tile, I said to my wife, just leave the tiles, just leave it. I cannot go on like this anymore. So I know that I won't be the guy that does a flat on my own property. But if you've got, that's the type of things that we need to discuss and get real questions
We
asked.
can help them. We can help them. We've got project managers in all the major cities who we collaborate with. And on the end of the day, can actually assist, get the quotes, verify that it's actually legitimate maintenance guys who can actually finish the
Because
job.
that 200,000 rand budget
become
is suddenly 400,000. I don't know how.
If you
Same
come
size,
down-
but it's 400,000 when you stop.
We've got 3 more questions. And if there are going to be some more questions, then please do. And it's definitely for you, Daniel, and for you, Gerard, from Nuka. And they're saying, how much does it cost to be part of Wealth Assist?
Can I just?
Yes,
The key question, guys.
It is the best value offering that you can get. 0. We only do business together.
Yeah.
We don't ask fees. We don't train you. You are trained while you are doing an investment. We don't sell courses or structures. We really go into property transactions from the initial plan that we set aside. I said, this is what you want to achieve. This is your metrics, your risk profile. This is where you want to be. This is how much money. This is your exposure. This is where you want to be. And then we take it from there. So there's no cost.
Maybe just to add something on that is that when you do actually do a transaction, there is a fee, which we call an external buyer fee, which you pay for us to actually give you this product. But if we quote you a net yield of 17% per annum, that means it's already deducted. Okay, so then actually you earn 19%, but you pay 2% for that to actually yield 17%. So most of our investments, whatever you see on our website, if it says 17%, that means all the costs are already deducted. Apart from your mortgage registration, if you do, but we can always include that as well.
But that's 1.75%.
Yeah,
per annum.
per annum.
That's the fee. So when we do a deal, the fee to us is 1.75.
Yeah.
So we're really making it
Correct.
affordable.
2 more questions. It's both from Ranji Naidu. Then would it be possible for individuals who want to buy the property on their own rather than collaborate?
Oh, you mean co-investment versus?
No, they don't have to co-invest, not at all. In actual fact,
Well, I think what they're saying is not co-invest. Yeah, in other words, collaborate or not collaborate, but then you're on your own.
Yes.
Well, anybody can do anything they want to do.
Oh, yes,
but
for sure.
But we can send them a picture of this because there's the 2 different processes that as a solo versus a wealth assist investor, there is a big difference.
Okay, so
But I think maybe we understood the question, not maybe right, but if you want to know what is the different ways, you can obviously most of our investors buy for them personally or in a trust or a legal entity or whatever, and we still do the job for them. The collaboration comes in; it's all inclusive, so it's not a question, but. Come to finance. If you want to use Multinet on your own, go for it. They're good guys. They know what they're doing. They'll advise you correctly, that type of thing. If you've got opportunities that you want to bring, we'll even review them for you, but then we will charge you a fee for it if you want to go and do it on your own. That is the maybe it's that question that we
absolutely. Yeah. Let's interpret it that way. And then the last question, I know of a buyer who had a loan, and it's more for you, here, Sean, and who had an excellent credit record with Standard Bank, but was not prepared to offer a better rate to the client. Investec offered him a better rate, so he switched his bond to Investec. One cannot understand that banks would try to keep a client, but here they did not offer a better deal. Well, that happens. That's the game, isn't it? No.
That is, yeah. Unfortunately, that's why origination is there. Not a single bank could be the best for one single customer. You have to have multiple options.
But I think one of the key points that you didn't mention about using a bond originator is the fact that you coordinate all the documents. And a lot of the time, if you apply to multiple banks, you have to
fill in all these.
You have to restart
and build the same people.
Exactly. What I like about the originator side is you keep the same one. If they do a good job, you just send the updated latest payslip, 1 or 2 things, and you're on for your next deal. The effort gets substantially less.
Yeah.
And you pay by the bank, right?
We pay by the bank, yeah.
And there's no extras, nothing on top.
No. Nothing
it's
on top.
Literally, as it is. So same cost.
And like I said, people are confused. They sometimes think there has to be a cost.
Yes.
And they have to pay for it somehow.
Yes.
One thing you must remember is it's cheaper for the banks to use origination versus having their own sales force. So if the banks had to have 7 people, each bank employs 1. With us, they only pay for the deals that get accepted.
Yeah.
So it's actually cheaper for them.
For sure.
Yeah.
Okay, on that note, I'm going to ask to give you a 1-minute wrap, each one of you in closing, maybe leave a parting shot, a thought to the audience out there. Maybe I'll start off with you, Sean, and then we can let Daniel. Just your final thoughts, maybe leave the audience with something that they could take away and say, yeah, I think I'll do that.
Yeah, I think, 2 things for me. Property has never gone backwards in the history of property. I've never heard a property go backwards. I have heard of properties not keeping up with inflation, but it always does grow. So it's not an asset that goes to zero. And the second thing is, if you're going to get finance, the best way is to go through an origination company. I'd love it if you use Multinet, but the origination industry is really there for consumers, and make a point of using them because it will be the best option that you have.
Well, I'll differ you on the end because most properties index for inflation. And if you look over the years, you actually see that property far outpaces inflation. Sure. And if you had to do a match between the two, I mean, we can go back and I could take statements from like 1920 where banks say, oh, property's too expensive. Oh, how are my children going to afford a property? And it goes up, but it's indexed for inflation. So it's going to grow all the time. It just becomes more expensive. Your closing comments there, Gerard?
Yeah, I would just say start investing. Listening to a billionaire, real estate billionaire, he was asked, so what's the difference between the rich and the middle class? He says, no, the rich save and the middle class pay their debt. And that's it. So if you manage your cash flow, stay away from unnecessary debt, you will start investing, and then you will actually get to the millions.
It's almost the compound interest story, isn't it? Either works for you or it works against you.
It's actually working against you.
Yeah.
Right. And that's why property is the only asset that makes sense to use finance or debt, if you want to call it. It brings its own risks. Don't play games with the banks as your partner in that, if you know that. But although, that's our business on this side, very much so, to save people who are in trouble.
Yeah, I think from my side, I think, guys, if you want good advice, go and do your homework prior, making sure, and surround yourself with a community of people. Build yourself these relationships. In property, there's few basic things. If you do them right, your chances over the next 15, 20 years, just as the past have shown us, your chances of creating wealth is very, very good if you surround yourself with the right teams, the right people to, on the end of the day, can provide you with the right advice to make the sound decisions in the beginning when you start doing the deals. And I'm tired of all my investors telling me about this one deal that they just lost so much. And I look at the homework and I think, how did we not pick this one up? And that's why we're there. So I'll just end up with that. Phone us rather. We don't have an attitude, okay, because you're going to do a deal through somebody else, we have a problem with it. I unfortunately going to help you to tell you what the risk is in this deal, because that's my job, okay? That you have to consider before you do those deals. And I'm going to show you that your yield is not always what you think. Okay.
And that's it. Flate. And story is 8. So, ladies and gentlemen, our live audience, thank you very much. I think it was wonderful having you here, and thank you for hosting us, Sean, here at the Multinet offices here in Johannesburg, in Randburg, and just so that you know where they are. So this is where we are broadcasting today. Thank you very much for hosting us. It's been great. Thank you for all your questions. To our audience out there, our ever supportive, loyal audience, thank you for joining us. We hope you got good value, got good responses and good advice. And certainly with our team over here, I think you've certainly got that. And until our next webinar will be every Thursday. It's from 12 o'clock to 1 hour. Encourage you always to join us. We've got different subjects every week, different guests, and we always talking the property story from all different angles. So I encourage you to to join us. So this is Neil Peterson from Real Estate Investors, Sean Rademeyer from Multinet, and the team at Wealth Assist, Gerard and Daniel. Thank you for joining us. Until our next one, which I'm sure we're going to be running there should be at least 2 more before the end of the year. We normally run it once a quarter, but we thank you again, and I encourage you to reach out to any one of the team members here if you need any further advice. The audience, thank you very much. Wonderful having you. It's Neil Peterson signing out. Cheers, everybody.